Imagine waking up and seeing one of the biggest pharmaceutical giants on the planet suddenly lose 8% of its value at the opening bell. Billions of dollars just wiped out in minutes, all over a single clinical trial failure. That's exactly what happened to AstraZeneca in July 2026. But here's the crazy part. Beneath that immediate panic, there's an underlying business operating with a staggering 84% core gross margin. So you have to ask yourself, is the market wildly overreacting to one setback? Or is this exposing a massive crack in AstraZeneca's $80 billion ambition? Let's dive right into this valuation disconnect and see what the numbers are actually telling us.
Now, that 8% drop, it wasn't some slow, gradual bleed. It was a sudden, violent reaction on July 9, 2026. AstraZeneca and its partner Ionis reported that their Phase 3 Cardio-TR Transform trial, this was for a drug called eplontersen, totally failed to meet its primary cardiovascular endpoints. The market just panicked. But contrast that panic with reality. Literally weeks later, on July 27th, AstraZeneca reported a second quarter earnings per share that actually grew 18%, completely backed by that elite 84% core gross margin. This creates a massive curiosity gap, right? How on earth can a company firing on all cylinders operationally get punished so aggressively by Wall Street?
So let's look at the economic engine. How does AstraZeneca actually make its money?
To really grasp this tension, we have to look at how this company was completely re-architected. Over the last 14 years under CEO Pascal Soriot, AstraZeneca pulled off one of the most successful strategic pivots we've ever seen in modern biopharma. They systematically moved away from their old primary care business model, which, is usually high volume, low margin, and super vulnerable to generics, and they transformed into this highly specialized global powerhouse focused almost entirely on oncology and rare diseases. Just look at their total revenue for the first half of 2026, $30.6 billion. You can literally see the engine at work here. Oncology is completely dominating, pulling in $14.1 billion. That's 46% of total revenue. Why does that matter? Because cancer therapies aren't just high volume, they command immense pricing power. We're talking high-margin blockbuster territory, driven by incredibly complex drugs like Tagrisso and Imfinzi. Then you've got Biopharmaceuticals at $11.2 billion, and this rapidly growing rare disease segment sitting at $4.9 billion, anchored by their life-saving therapy Ultomiris. This is a business fundamentally built on extreme clinical complexity, and that creates a near impenetrable barrier to entry. And that clinical complexity? That is exactly where that massive 84% core gross margin comes from. AstraZeneca's economic mode is basically built on three giant pillars. First up, dense intellectual property matrices. This protects their crown jewel assets, like Tagrisso, from generic knockoffs for years to come. Second, extreme switching costs. Think about the human element in that rare disease segment. If you're a patient successfully stabilized on a drug like Ultomiris for a really severe, life-threatening condition, the psychological and clinical barrier to changing your medication is just monumental. You and your doctor are highly unlikely to switch to a cheaper biosimilar, because the risk of your disease reactivating is totally unacceptable. That creates incredibly sticky, recurring revenue. And third, massive clinical scale. They're running over 100 Phase 3 trials globally right now. That kind of infrastructure lets them aggressively attack massive total addressable markets, or TAMs. They're going after a global rare disease market that's projected to hit an unbelievable $425 billion by 2034. Plus, they're unlocking a huge COPD biologic opportunity with a drug called tisorakimab, which by itself has a peak sales potential of $3 to $5 billion. They have the scale and the cash to fund these high-risk endeavors without even breaking a sweat. Okay, so what is the market's concern? Let's talk about the central conflict.
With an economic engine that powerful, why did the stock sell off so hard? Well, the market is constantly weighing the durability of AstraZeneca's pipeline against some pretty imminent threats. Let's objectively weigh the bear case against the bull case here. The bears are pointing straight at that Cardio-TR Transform trial failure we just talked about. Because eplontersen failed its primary endpoints, AstraZeneca essentially loses its near-term entry into a highly lucrative cardiovascular market, handing that share right over to competitors like Pfizer. On top of that, their blockbuster diabetes and heart failure drug Farxiga lost its U.S. exclusivity in April 2026. That means rapid generic erosion is eating into those revenues right now as we speak. Throw in a frustrating regulatory delay from the US FDA for their breast cancer drug canazestrant, plus some predictable class action lawsuits over that trial failure, and yeah, you've got a solid wall of worry. But the bulls counter all of this by pointing to AstraZeneca's absolute unmatched dominance in next-generation oncology, specifically antibody-drug conjugates or ADCs. Think of an ADC as a guided missile for cancer. It combines a targeting antibody with a highly toxic payload, delivering chemo directly to the tumor cell while completely sparing the healthy tissue. It's revolutionary. AstraZeneca actually just secured a massive FDA first-line approval for their ADC datromazine for metastatic triple-negative breast cancer back in May 2026. Beyond that, they've got 183 active clinical projects, 21 late-stage new molecular entities, and again, that fortress-like 84% core gross margin acting as a massive shock absorber.
So let's look at the financial evidence. Here are the H1 and Q2 2026 results. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. To really settle this pipeline debate, we have to look at the hard financial evidence they reported on July 27, 2026. How did the business actually perform while the market was losing its mind? Well, in the second quarter of 2026, AstraZeneca delivered an adjusted core EPS of $2.63. That definitively beat Wall Street's consensus of $2.48. If we zoom out to the first half of 2026 comprehensively, total revenue hit $30.6 billion. That's growing at 6% at constant exchange rates. Core operating profit grew an impressive 11% to over $10.5 billion. Now here is where the market disconnect becomes super glaring. Total revenue technically missed analyst estimates by a tiny fraction, literally just 0.45%. Wall Street aggressively punished the stock for a fraction of a percent revenue miss, completely ignoring the fact that profitability utterly outshone the top-line noise. They achieved this bottom-line beat because of a highly favorable product mix, selling way more of those high-margin oncology therapies, combined with incredibly disciplined control over their SG&A expenses.
What's more, this financial resilience isn't just propped up by one product or one region. It's geographically robust. Look at this growth breakdown for the first half of 2026. The US grew 8% to $12.9 billion. Europe grew 8% to $6.8 billion. And China? China is the real standout here. Despite intense macroeconomic headwinds across the Chinese economy and aggressive volume-based procurement pricing pressures from the state, AstraZeneca still grew revenue in China by 10%, hitting $3.5 billion. This kind of global diversification is the exact mechanism a pharmaceutical giant uses to absorb a localized hit. Yes, the US patent loss of Farxiga definitely hurts, but because the US, Europe, and emerging markets like China are all growing independently, the overall top-line trajectory remains safely intact. Management was acutely aware of this dynamic, and they addressed it head-on during their July earnings call. CFO Aradhanasaran explicitly stated that their broad portfolio and diverse geographic mix allow them to entirely absorb the financial impact of the US Farxiga loss of exclusivity. Based on that exact strength, the company completely reconfirmed its full-year 2026 guidance, projecting mid to high single-digit revenue growth and low double-digit core EPS growth. They are not backing down at all. They remain entirely anchored on their massive Ambition 2030 target to reach $80 billion in total revenue. Next up, our qualitative scorecard analysis, where we assess the actual business quality. Based on our deep dive, AstraZeneca scores an exceptional 8.6 out of 10 on our blended qualitative scorecard. Let's unpack exactly what's driving that premium score. Revenue quality, profitability, and track record, they all pulled top-tier 9 out of 10s. We rate revenue quality this highly because of the inherent pricing power and the patent longevity of their oncology and rare disease portfolios. These specialty therapies are just significantly less sensitive to price erosion than older primary care drugs, meaning they generate incredibly high-quality recurring cash flows. Crucially, though, management alignment sits at a strong 8 out of 10. And honestly, this is the cornerstone of the long-term thesis. CEO Pascal Soriot's executive compensation is heavily dictated by the AstraZeneca Performance Share Plan. This is not just a simple stock option payout. This plan enforces strict scientific, commercial, and financial metrics over a mandatory 3-year performance period before a single share even vests. It legally ensures that management only wins if genuine, long-term shareholder value is created. They're financially incentivized to make the hard, long-term clinical bets rather than just chasing short-term quarterly beats.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years, hidden gems, under-the-radar names with asymmetric upside, dividend hunters, durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes. Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
All right, let's look at the 5-year scenario framework, the base, high, and low cases.
Before we break down the math here, I need to clearly state this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. Let's anchor ourselves. The current share price sits at roughly $159.56. In our base case, which carries a 60% probability, we assume AstraZeneca successfully executes its Ambition 2030 strategy. Operationally, this means revenue compounds at a 6.5% annualized rate, reaching $80.4 billion in year 5. Because the product mix continues shifting toward high-margin specialty oncology, overall margins expand to 28.5%, yielding an EPS of $15.09. If the market applies a conservative 18 times multiple to that highly protected earnings stream, we get a target of $271.61. From our current price, that offers a 70.22% total return, which breaks down to an annualized share price growth of roughly 11.2% over the next 5 years. Now, our high case, sitting at a 25% probability, models absolute pipeline dominance. This happens if the new COPD drug, tozorakimab, hits the high end of its $5 billion peak sales target, and the breast cancer ADC, datropantoway, sweeps the market. Revenue surges past $90 billion, operating leverage pushes EPS to $19.24, and the market rewards them with a premium 22 times multiple. That results in a $423.19 target, representing an incredible 159.77% total return, or an annualized share price growth of 21.5%. But we must realistically model the low case holding a 15% probability. This assumes everything goes wrong. Severe, rapid generic erosion of Farxiga, crushing government pricing pressure in China, and catastrophic late-stage clinical failures. In this scenario, margins compress to 22%, capping earnings at $9.60. The multiple contracts to 14, and the stock falls to $134.44. That results in a negative 10.82% total return, or an annualized decline of 3.4%. And remember, if you want to access the full model with all the detailed assumptions for each scenario, you can check out the full research report over at flash.stocksentinel.ai.
Moving on to our risk analysis, what could actually break the thesis? So what actual concrete threats could push us into that low-case scenario? We've mapped the threats on a risk matrix to separate the day-to-day noise from the real existential dangers. First up, we have our high probability but low impact risks, specifically the accelerated U.S. generic erosion of Farxiga. It is an absolute certainty that this is happening, but the overall thesis impact is pretty muted because the sheer scale of the oncology and rare disease growth engines easily absorbs that revenue hit. Second, medium probability, medium impact, the FDA delay for camizestrant. In April 2026, an FDA advisory committee essentially rejected the primary efficacy endpoint used in their trial, delaying the U.S. rollout. Now, that's an expensive setback for sure, but it doesn't fundamentally break the company's long-term trajectory. The real existential threat, the low probability but high impact risk, is clinical stagnation combined with premature patent loss. As investors, you need to watch for early warning signs here. The canary in the coal mine would be consecutive phase 3 failures across their high-value pipeline. Specifically, you must watch the upcoming clinical readouts for datropantoway and tozorakimab. If those foundational drugs fail in late-stage trials, and it happens to coincide with an unexpected patent invalidation for their current crown jewel, Tagrisso, well, that is the perfect storm. That is the exact scenario that shatters the Ambition 2030 strategy and permanently contracts the valuation multiple. All right, let's wrap this up with the final verdict. Bringing this entire story together, here are the 3 most important takeaways. 1. AstraZeneca is no longer just a generic drug company. It is a self-sustaining oncology growth engine. Drugs like Tagrisso and Imfinzi generate massive, non-dilutive capital that funds their next generation of high-risk clinical trials without stretching the corporate balance sheet. 2. The massive upside in our high case is entirely dependent on unlocking those massive total addressable markets with datropantoway in breast cancer and tozorakimab in COPD. 3. Do not ignore the structural mechanics at play. Back in February 2026, they completed a direct listing harmonization on the New York Stock Exchange. They eliminated their old clunky ADR program and listed directly on a one-to-one parity basis, which significantly enhances liquidity and makes it way more attractive for major U.S. institutional capital. As for what to watch next, it all comes down to clinical execution. They have over 20 high-value clinical pipeline readouts expected over the next 18 months. Those readouts will absolutely dictate the future. Which brings us right back to our opening conflict. Is the market completely overreacting to the Cardio-TR Transform trial failure, or are they just missing the incredible durability of that 84% margin moat?
Based on our deep fundamental analysis, when we apply probability weighting to our three scenarios, it yields a blended target price of $288.93. This heavily suggests that the market's initial 8% sell-off was indeed a near-term overreaction to an isolated pipeline setback. In the chaos of the moment, the market was temporarily blinded to the sheer recurring cash-generating power of AstraZeneca's broader specialty portfolio. The margin moat is incredibly wide, and it is holding strong. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.